Welcome to This Explainer. Today, we're challenging the market's current perception of Dell and mapping out the ultimate AI infrastructure endgame. Look, for institutional investors navigating the multi-trillion-dollar AI space, the stakes have literally never been higher. So we're going to look at the hard financial realities, the structural bottlenecks, and the true relationship between Dell and NVIDIA to figure out exactly where the value is occurring right now.
Here's our roadmap for today's explainer. 1. The AI infrastructure endgame. 2. PC vendor or AI architect. 3. Comparing Dell and NVIDIA margins. 4. Dell's thermal competitive advantage. 5. Acquisition versus deep partnership. And 6. The long-term hold strategy. Let's get right into it.
Starting with Section 1, the AI infrastructure endgame. We are currently witnessing a massive, multi-trillion-dollar consolidation in the AI factory market that is fundamentally altering the hardware value chain. Which brings us to the ultimate question every portfolio manager has to answer right now. Is Dell a legacy PC vendor, or are they an AI infrastructure architect? The market is seriously wrestling with this. Dell shares have surged 156% over the past year, purely on the back of this strategic pivot. Yet some analysts out there are still pricing it like a traditional hardware supplier. To figure out if Dell is actually a solid long-term hold, we need to look past the corporate branding and dive straight into the actual order books.
Moving to Section 2. PC vendor or AI architect.
Let's look at the hard financial numbers driving this massive identity shift in the enterprise market. Check out this staggering figure, $43 billion. That is Dell's record AI server backlog entering fiscal year 2027. To put that into perspective, that backlog alone is larger than the entire GDP of some small countries. It represents a massive 38% of their entire fiscal year 26 revenue, which was $113.5 billion. This is not some future projection. This is unprecedented visibility into actual enterprise hardware demand. The momentum in AI servers here is just striking. Record bookings and shipments are completely reshaping Dell's overall revenue profile. Now, here is the absolutely crucial point, the 20% threshold. Right now, the broader market still largely prices Dell like a PC vendor, trading at a price-to-earnings multiple in the mid-20s. But financial analysts highlight that once AI server revenue crosses this 20% threshold of Dell's overall mix, well, the market is poised to completely re-rate the stock. Dell effectively moves from being categorized as just another OEM to a pure NVIDIA ecosystem play. And that shift could expand those multiples from the mid-20s up toward 30x. For portfolio managers, that is exactly where the massive financial reward sits if you're monitoring the shift closely.
Section 3. Comparing Dell and NVIDIA margins. To understand why these two giants desperately need each other right now, we have to evaluate their mirror image business structures. This brilliantly illustrates the dichotomy we're looking at. We have two titans occupying completely opposite ends of the value chain. NVIDIA is a fabless silicon designer, right? They've got this capital-light model yielding massive operating margins of around 62%. On the flip side, Dell is a system integrator commanding a massive global supply chain. It's an operations-heavy, much lower margin business, sitting at around a 10.5% operating margin. So NVIDIA dominates the high-margin silicon and software, while Dell commands the physical, low-margin, incredibly complex supply chain required to actually deploy it into the real world. Simply put, you just can't build an AI factory without both halves of this equation. On to Section 4, Dell's thermal competitive advantage. Let's see how this builds into Dell's unique technological moat in the physical data center realm. Because honestly, it's not just about assembling parts anymore. It's about physics. 480 kilowatts per rack. As NVIDIA pushes the absolute boundaries of silicon with Blackwell and its future generations, the heat generated is astronomical. We are talking about a single server rack producing enough heat to warm dozens of homes. Dell's Smart Plate microconvective cooling supports up to 480 kilowatts per rack. That's a massive differentiator. It makes Dell the only Tier 1 OEM currently capable of supporting the extreme thermal envelopes required for the next generation of AI compute. This isn't just a nice-to-have feature. Cooling is a structural bottleneck in the entire industry, and Dell literally holds the key to unblocking it. Section 5. Acquisition versus deep partnership. With such perfect synergy, rumors naturally swirl. So we need to strategically evaluate the probability of an outright NVIDIA acquisition of Dell versus a deep structural alliance. As we scenario model this for your portfolio, look at the probabilities here. An outright acquisition by NVIDIA would command a massive 30 to 50% premium, costing an estimated $200 to $250 billion. Now, while that is technically executable using NVIDIA's cash and stock, the probability is incredibly low. We're estimating only 10 to 15%. However, a deep strategic partnership, what we call a de facto integration without an actual legal merger, carries a 70% plus probability. It is clearly the path of least resistance.
So why is the partnership path so much more likely? Well, these 5 strategic pillars clearly dictate the outcome. First, a legal merger would immediately trigger severe antitrust hurdles, because the combined entity would control over 60% of the AI infrastructure market. A partnership entirely bypasses that regulatory nightmare. Second, it protects NVIDIA's existing sales channels to other OEMs like HPE and Lenovo. Third, it's all about capital efficiency. Taking an equity stake or forming deep contracts is roughly 20 times cheaper than a full buyout. Fourth, partnerships are reversible if market dynamics suddenly shift. And finally, founder alignment. Michael Dell has repeatedly signaled a very strong preference for keeping his company independent.
Section 6, the long-term hold strategy. So what does this all mean for you? What is the ultimate recommendation for your AI infrastructure portfolio? How should you position yourself for this endgame? It all really comes down to completing the puzzle of value chain consolidation. Jensen Huang himself declared that we are entering a $3 to $4 trillion AI factory era. NVIDIA obviously holds the foundational silicon piece, controlling over 90% of the GPU market, and they own the core software piece with CUDA. But the AI factory loop is not closed without the final 2 pieces, systems integration and enterprise deployment services. And that final physical deployment layer is exactly where Dell leads the pack.
I'll leave you with this final, definitive thought from our analysis. Acquisition is the drama, partnership is the reality. Dell and NVIDIA are already operating as the Wintel of the AI era. They're co-engineering, joint branding, and completely locking down the reference architectures for the future. For institutional investors, understanding this deeply symbiotic relationship proves that Dell isn't just some legacy PC maker enjoying a temporary bump. It's an absolutely essential long-term hold for the AI infrastructure era. So I have to ask you, as the AI factory market matures, are you still valuing the companies building its physical foundations with the metrics of the past, or are you ready to price in the future?